All right, in today's video, we're going to be answering the question, are you too old for life insurance? Are you too old for infinite banking? Are you too old for what we call the and asset strategy? This is a question that we get a lot. Justin, I can't tell you how many times people will hear me speak and they'll be like, man, I wish I would have known this at your age, but I'm too old. And I'm like, you're 45 years old. You're 50 years, you're 60 years old, you're 70 years old. We have clients that are 80 years old. So it's always amazes me that people put that belief just around this concept of them being too old. But I'm really grateful because I don't think we've had a video that breaks this down. And to make this happen, we got the one and only Justin Gartman, who is now getting into Google Slides. I think Austin is inspiring this. It's either Slides or Google Sheets, but you've abandoned the Google Sheets pretty quickly, which is kind of disappointing, but we're gonna see if the Google Slides can redeem themselves.
Yeah, I thought Austin, it looked all pretty, so I wanted to take the Google Sheets, make it pretty right here. So I did copy and paste some Google Sheets in here.
There you go. Okay. So we're still overlapping a little bit. You're the Google Sheets wizard at Better Wealth, so wouldn't want it any other way.
Yeah, so I think just like you said, I get that question all the time. The answer is no. You're probably not too old. In most cases, I've worked with 65-year-olds, 70-year-olds, and here we'll be looking at just differences in what it is. So to answer everyone's question, keep watching. But the answer is no. Especially the big question is yeah, I'm not too old for insurance, but the way you guys design it, I want high cash value. I want it to be flexible premiums. I want a growing death benefit. Am I too old for that? Again, answer is not. We can work with you. We can make it happen. And so today we'll look at first kind of two examples. First thing we'll look at is exactly what's here, a $15,000 annual premium with a preferred health rating. That is the key. Obviously, the older you get, you may not be as healthy. Here, we're going to keep it the same. Where say your preferred health rating. And we'll look at a 20-year-old, 35-year-old, 50 and 65-year-old, same amount of premium going in, how that breaks down and some of the differences here, all at one company. So to try to keep it the same and just explain how the age may be different.
Love it. I love it.
Yeah. So first, start off here, year one of the policy, 20-year-old, and each one we're going to show the same thing. So minimum premium, that includes the base amount of insurance and the term insurance. If you want more information on term insurance and how that works and applies, watch the video Alden and Demetrius did. It'll blow your mind there. You'll learn all the details there. Then how much paid up additions we're able to put into it. So that's how much we put in, $12,000 of paid up additions for a total of $15,000 premium, and show you cash value year one, over 80+% of cash value available year one, and just to show death benefit there as well. So that's a 20-year-old. Take it up a notch, get a little older. 15 years later, 35-year-old, very similar. You see here, it's not much different. Obviously, your minimum premium is going to go up. So $2,813. So that means slightly less paid up additions to get to the same amount of premium. Because I know, Caleb, as you know, the goal of the way we want to do the policies, we want to minimize the base, minimize the minimum, to get as many paid up additions in there as possible. So
So already we're seeing a theme that the older you get, looks like the base the minimum requirement increases a little bit, and the initial death benefit goes down a little bit. That makes sense because a 35-year-old is closer to quote unquote death than a 20-year-old on paper. And then the cash value in these scenarios, obviously when you're a little bit younger, you're putting more to PUA, and so it's no wonder that the cash value is a little bit more optimized. But I find that over time, it's less of a big deal.
Yeah, it's something where you see the differences right off, and I think that's true. I know a lot of people talk like, what's the minimum I can start with? And we typically are like, hey, if you're getting to your 30s, around 10,000 a year is a good frame of reference, because we want you to get where you're able to put enough paid up additions in there for it to make sense and do the things that you want it to do. So that's 35. 15 years later, you get to 50, and you see it goes up even more than what it did there, because again, you're not just fighting time, you're fighting the ongoing cost of insurance, knowing each year you get older, yes,
Yep.
you're closer to death. It's the one thing we know. It's going to happen to all of us. And so see your minimum premium goes up, less paid up additions, and
Yep.
therefore also less death benefit there.
And still want to know, you could be 50 years old and have a way better optimized policy than 95% of people that design insurance in general for even a 20-year-old. So I'm not like, these are things where we're giving you like inside baseball and how we look at things. But overall, like, this is still a really well designed policy. And that 50-year-old, I'm not sure if we're going to see it in this video or not. That policy is still going to perform quite well when you compare it to what that person could do alternatively.
Yeah. Yeah. None of these are bad. People that ask that question all the time, am I too old? I'm like, you're not too old. Just don't think of it as a 20-year-old. You're
Yep.
30 years older now. So for this, for a 50-year-old, this is still a great deal. You get nearly $12,000 of cash value year one. And no one's going to complain about that policy there. And then even further, 65 years old, it jumps up even more, nearly $2,000 there. Because at 65, you're really approaching the age where it can get more expensive, and you could even go up to 70 and so on from there. But you see the differences there. Obviously now 11,000 and a much lower death benefit there. So that's all year one. And then we'll skip forward now 10 years later just to see how it would perform if you did the exact same thing every year here. And now we're just looking at cash value and death benefit and then the current age. So obviously the minimum's going to stay the same, all of that good stuff. So here, see the cash value is obviously grown quite a bit. Death benefit is now quite large. Same thing, 35-year-old cash value, very similar, not too far behind. Death benefits where the biggest difference is going to be here.
Yep.
But I don't know many 35-year-olds that would complain, I'm putting in $15,000 a year, have this cash value, have a decent size death benefit, but you're also 45 at that point. Same thing, 50, you're 60 now, $500,000 death benefit, and your cash value is $169 for what you've 65, just to see the differences. And again, biggest difference is that death benefit, but here you're going to be 75 years old. I know a lot of 75-year-olds would be like, if I had 323,000, and again, your minimum here is only 5,000. So wouldn't have to be paying that high of a premium each year.
To note, every one of these policies are broken even. And even if you put the 65-year-old, you're 75 years old, you've put in 150,000 into the contract. You have more than that. You have a death. You've doubled your money essentially, and you can use that capital. And so that's it's pretty phenomenal. And I really appreciate how you made this happen, because you're able to see that age does matter, but maybe not as much as you may think from a cash value standpoint. And note that we're like, the design, it wasn't identical designs. So maybe that was because you had to. But it's like there's that's just the note that I would say is you had to maybe create more base when they're older. Because maybe you can break that down to why.
That's right. To get it to be really apples to apples, to be we're putting in 15,000 and justify it that way. Now, there's a world where maybe we could look at like all of these are the same company. Potentially, we would want to do something else and get the base a little lower for the same amount, but to keep it as fair as possible, just for comparisons for everyone to see. And you can see even doing that, like you said, we're not too far off cash value wise, so that you can see absolutely 30 years there doesn't make a huge difference in whether you start when you're 20 or 65 cash value wise. Death benefit, obviously it does. And so that's where the biggest difference is going to be. And then again, we'll fast forward here to year 30. So saying, hey, now we're 30 years into the future here. 20-year-old, you're going to have $1 million of cash value, $2.7 million death benefit, and your age is 50. And I went ahead and put this minimum payment here because 30 years down the road, that could be important. You're looking at, hey, I can keep this policy for $2,000 a year and have all of those benefits there. 35-year-old, similar situation, cash value, again, very close because you've put the same amount of money in each year. Death benefit's going to be different. 50-year-old, now you've seen over that time the difference that small amount of cash value can make as it has time to compound. But of course, you're an 80-year-old with $1 million death benefit, you can pay less than $4,000 a year for. And then even better, 95-year-old, $5,000 a year, and you have a nearly $1 million, 762. So round up quite a bit to get to $1 million there. But that's going to be the difference there. So none of these bad for what they have. I know any 95-year-old would probably love to pay $5,000 for $762,000 of coverage.
And just to note, I'm kind of answering the same question, because to make this an apples to apples comparison, to have them pay 15 grand for 30 years, that's why older people in this example, we had to bump up their base so that we could maintain that. Even if you're 50 or 60 or even 70 watching this, there's a lot of different things that we could do to potentially even make it more advantageous. You just might have a smaller death benefit, and you may not have the ability to pay the same premiums for 30 years. And that may or may not matter to you. If that did, then this is the optimal way to do it for this company. But I just want to plant that seed, because I now get to why the bases had to be higher, because we're not dropping anything off. We have to keep it apples to apples, which I appreciate.
Yeah. And it's something where, would I do the same design for a 20-year-old that I did for a 65-year-old? The answer is probably no. But for this, that makes is just to make sense and see that it really doesn't matter. You're not too old, at least to have a conversation and see what we can do.
Yep.
So that's one way to look at it. So now, more than likely, what most people would come to us and they may say, kind of two options here of, I want this amount of death benefit by age 65, or I want $1 million of cash value by age 65. What does it take for me to get to that point? And so here, not looking at a 65-year-old anymore, because guess what? To get $1 million by age 65, you're going to have to put in a little bit more than $1 million.
You need to be worth $1 million. Put over $1 million.
You need it. I gotta have that. So dropping it down, 20-year-old, 30-year-old, 40-year-old, 50. And again, looking at not just death benefit life insurance. Of course, you can get that and say, I want this death benefit. That's pretty easy to do. But looking at it, I want flexible premiums, low base, high PUA, to get the cash value and see what that looks like now. So we'll start here. 20-year-old, pretty easy. Obviously, you think about it, if you're younger, probably don't have as much excess income to put into it. So $6,000 a year. And all of these I did round to this number. So $1,026,000 there. And your death benefit is going to be about $1,696,000. And you can see your total premium that you have paid in.
I love it. And I think the disclaimer is, we're using current illustrations with current dividends. You could make the argument that dividends will go up. You can maybe make an argument that it's going to stay the same, and you can make an argument that it could go down. So it's not like we're using a crazy projection that we're pulling out of nowhere, but that is a legit assumption.
Yeah. So this is assuming, obviously, way down the road, and never want to be like, hey, look, you're going to have this and plan on that exact amount. Dividends go up, down. But again, all of these are using the same dividend, so you can get an idea of, guess what? If it goes down when you're 20, if you started at 35, it's going to be the same. So we can see the comparison there. Other big thing was that minimum payment of $960.
Wow.
Obviously, it's pretty low, and you have that till you're all the way for the rest of your life there.
It's amazing.
Next thing, a 30-year-old. So right here, this 30-year-old, you see that you are going to have $11,000. So it's gone up a little bit. Now you almost double to get to that $1 million mark. And it's not exactly here, because it would be almost impossible to get it to be exact in the illustrations here, but same thing. And other thing is, now you also have a little bit more of that death benefit, because your base is going to be a little bit higher there to get to that point. And again, just to show you the total amount of premium going into the policy, so you kind of see over time how much it takes, because you're really fighting against two things. You could look at just a investment calculator and know that, hey, if I put in less money for longer, it's going to be bigger. Here, you're also looking at, it may cost a little more insurance wise as well. Next, that 40-year-old, again, almost doubles here, get up to $21,000 a year, get to $1,029,000. Death benefit again bumps up, and now your minimum payment is slightly higher. But again, if you start this when you're 40, like you said, you have 45-year-olds come up to you and ask if they're too old. Definitely not.
Yep.
Starting out in 21,000, I know there's lots of 40-year-olds that have that, because then you're making good income and stuff. That it may
Yep.
be something where you can do that, can do more, can do slightly less, but to give you an idea of what it might look like. And then for the 50-year-old, did something a little bit different here
Yep.
than what we did here. So for this 50-year-old, rather than looking at, hey, let's put in the same amount every single year, kind of
Yep.
flipped it. So it is slightly different. And so let's look at a front load, because we now only have 15 years to get to that point where you have $1 million of cash value. So let's do a front load. And then after that, drop it down to about $45,000 per year. Again, flexible premiums, high cash value.
Yep.
And so you see what it takes to get there, have about a $2 million death benefit. And again, your minimum payment here, less than $6,000 going into it.
Hmm.
So looked at it a little bit differently for the
Yeah.
50-year-old, because
Got
that
more
was one thing
creative.
that,
Got more
yeah,
creative.
you have to
And
a
to
little
be
more
fair,
creative.
you could do that for the 20-year-old, 30-year-old, and 40-year-old and have way less premium outlay because of time value of money when you front load. But I love the creativity, because I think that will plant seeds where if you're in your 50s, 60s, 70s watching this, there's actually a lot of different ways that we can approach your situation. What I appreciate about you is showing the apples to apples comparison and showing the pros and cons. Obviously, younger the better. I think that's, not only are you potentially healthier, but you just have more time, and with more time creates opportunities. So I think this is great.
Yeah, that's the biggest thing. Obviously, tons of ways that you can design the policies rather than just, hey, same amount every single year. And so
Yeah.
15-year-olds, sometimes we do need to get a little bit more creative. Actually, this one, for this $125,000 front load, had about $115,000 of cash value available in year one. So yeah, you're 50, and we can still get you 90% liquidity in that first year, which is pretty amazing when you think of it from that perspective. I would say, yeah, it's also fun sometimes to get more creative. So if you're older, want to call in and give us hey, here's my goals. Can we make this happen? I know any of us would love to have a conversation with you and be able to do that, because it is a fun thing when we get to look at the options that are possible for you.
Yeah. When you did this, were you surprised? Was there anything that like jumped out to you that you're like, hey, like I didn't know what to expect? And or what, did it seem pretty accurate because of you're always crunching numbers, and so you always knew this, but you kind of put Google Sheets to that assumption?
Yeah, I would say I had some ideas of what I expected. Like, I expected the death benefit for sure. Like, that's going to be the biggest difference. But I was relatively surprised on just the closeness of the cash value over the time. That even if you're 20 versus 50 or 65, that the cash value kind of available to you was not a drastic
Yeah.
difference.
The big
I
difference
was
is the death
surprised by that.
benefit. And
Yeah.
like I said, early on in my career, I downplayed the death benefit, and now I just see it as such an amazing asset. So if you're young, the ability to have capital but also growing death benefits, just very attractive. And
Is a
all of
big
this,
thing.
yeah, all these things are pretty attractive. But yeah, I love the front load $45,000. It's a creative way to think outside the box, and the likelihood of a 50-year-old potentially having money that they could front load the first year is a lot higher than the likelihood of a 20-year-old. So I think it's a cool angle to provide.
Yeah, I think that, and I'm glad you bring up the death benefit part, because that is important. I know pretty much not every, but most 20 to 30-year-old that I talk to, they're not worried about death benefit, obviously looking at cash value. But when it's designed in this way, obviously you can get some of both. When you're older, you're going to have, obviously in this one, $1.6 million of cash value. And as I also talk to older people, most of the time when they're 50 plus, they're more interested in the death benefit. They're like,
Yeah.
hey, I want cash value. That's what I'm here for. But also, what's that death benefit going to be like? Because now I have kids, grown kids, and I want to make sure and leave that. So it's definitely not something to downplay. And
Yeah.
obviously, we can make that go up, down, and really prioritize what you want. If you want more death benefit, obviously the answer is more base, but it may not grow as much and different things like that. And it can all
Yep.
depend on what your why you want the policy
Yep. Love
is.
it. Well, Justin, anything else that you have? This is great. And I just want to say, if you're watching this and want to talk to someone on our team, there are links below with where you can schedule a call. If you want to learn more about life insurance, not only is this channel an amazing resource, but we have what's called a life insurance vault for you. So you can click that. And obviously, we would love to hear from you in the comments if there's other video ideas that you have. We make these videos because we try to answer questions. And so maybe if no one asks questions, we're just going to stop making videos. But I doubt that's going to happen because we hear from so many of you. Tell us what you want us to make videos around. We'll make it. And we just super appreciate the support. Justin, any final words?
Yeah, I would just say, just really to go back and answer the question, you two all know. And I think that the best thing to do is give us a call, have a conversation. Because if there's something that you're like, hey, I want this to happen, I'm this old, here's how much money I have, I'll shoot you straight and say, hey, we're not going to be able to do that. Here's what we can do. Here's what we can design for you. Or I mean, like, yeah, that's easy. We can do that all day. And so the best thing to do is get on a phone call with any of us, and we'll be happy to help and point you in the right direction.